How's everybody doing today? Good. Good interaction. I like that. All right. Well, I have to say I'm both challenged and excited to be here today excitement because I get to give back, obviously, and challenged because I could talk about this all day. Literally, most of my training videos are over an hour long each, so in an effort to serve you as best I can today, because that's why I'm here, is to serve you guys. Any of our training videos, products, anything, just get in contact with myself or my support team. And anything you guys want, free of charge, no problem at all. So just let me know, and then you guys can have that. That's kind of a gift from me to you today. So thank you very much for being here at this event. So when I was hired on as a portfolio manager at a hedge fund, I had this mentor that I talked to all the time, and he'd always come back to these simple concepts, and he said he'd always liken it to a child walking for the first time. So as we get into this, if you feel a little overwhelmed or discouraged, don't. And he'd always come back to this example as a child walking for the first time, because if you've ever seen a child walk for the first time, it is kind of funny, it's kind of silly, right? You kind of laugh. You don't think they're ever going to get it. And then all of a sudden, they start walking, they start developing, and they're actually, coming into fruition. And they don't think about it, they just do it, and it's just part of who they are. And that's kind of how investing is. So as we go through this, and if you feel discouraged at all, just remember it always starts with that first step and those simple concepts, okay? So where is the individual investor today, and why should I care? I mean, I'd be asking that if I was here at this presentation, right? Well, the individual investor today is essentially leaving the markets, and we should all care about that because essentially we all need to outpace inflation and taxes long term in order to maintain our purchasing power or maintain or grow our quality of life over time, right? And if you look at the investing landscape today, we have bonds, cash. Those aren't necessarily going to get us there, right? So you look at real estate's great, but there's a liquidity factor there as well. So we have equities. And equities can be a scary place for people, right? As we'll see in just a moment, equities is kind of the best house in a bad neighborhood, so to speak. That's what a lot of people like to refer it as. And the numbers we'll show in just a second show it's a little scary because we know that equities have outpaced over every major asset class in the last century by a significant margin, yet individual investors are leaving the marketplace, and we don't want that to happen. So as you'll see by these slides right here, according to a study by Prudential Financial, 54% or 53% have lost faith in the market completely, right? And another 44% say they'll never invest in the stock market again. These are incredible numbers. Another study in 2014 by Gallup poll shows that Americans who own stocks is at the lowest total in over a century, essentially, at 54%. And only 46% of Americans polled say they'd invest $1,000 in the stock market today. These are incredible numbers. And I don't say any of this to scare you. And in fact, it's quite the opposite. These figures here show the 4 most perilous market declines in the history of the stock market over the last century. And as you can see, the long-term rational investor actually did quite well. I mean, if you invest in the stock market and persevere through economic or market declines, you didn't do too bad. Let's take the Great Recession, for instance, in 2007, 2008. If you invested $1,000 at the height of that market and persevered through market declines, you would have made your money back if you invested $1,000 every year thereafter, which is not uncommon given retirement accounts or whatnot. And you would have made your money back in 2 years and then some, right, as you were still invested. So it's not as bad as people make it out to be. So there's essentially 2 ways to go about this. I mean, there's 3 ways to invest in the market, right? You have index funds, you have asset allocation strategies, you have a portfolio of individual securities, okay? We'll go back to this slide real quick. Index funds, asset allocation strategies are great, but essentially they're going to track the market because they are investing in broad market indices. So they're going to produce average to about below average returns because of management fees or whatnot. So we know that we want to be in a portfolio of individual securities. So how do we go about investing in individual securities, right? Because that's where we know we need to be. There's 2 ways to go about this. There's a formulaic approach. There's a framework approach. Formulaic approach is kind of a rules-based strategy. It's fairly easy. We won't go over that right now. It'll take days to go over that, but you can read these two strategies on the top: acquirer's multiple and the magic formula approach. Acquirer's multiple was created by Tobias Carlyle, and the magic formula was created by Joel Greenblatt. Both great guys. I know them personally, and I recommend them wholeheartedly. I am partial to the acquirer's multiple, though, because it has produced better risk-adjusted returns over the long term. But the framework approach is interesting because, and I think it's just as important, if not more important, than the formulaic approach. Because knowing businesses, knowing the stock market, knowing what the stock market does will help you from making bad decisions as you invest. So, as we know, investors are scared to death of investing, right? The numbers have showed that. And that's the entire reason, the entire hypothesis behind what we created here with the 5M mental model and the Mecca Method. So the 5M mental model is a simple mental model, and that's by design. We want to keep things as simple as possible, right? So the components of this framework help us stay focused on a repeatable, proven value investing approach, with the first M standing for market, which is how we want to view our competitors. The second M is mindset, and the third M is morals, which is kind of your investing philosophy. The fourth is the Mecca Method, which we'll go over in just a second, and the fifth is the margin of safety component, okay? And these will help you kind of stay focused on how we want to approach investing, with the last two being the most important, which is why I've kind of highlighted them right there. And we'll go over a case study right now in just a second to kind of drive home the point. So the Mecca Method is essentially a mnemonic trigger, an acronym that stands for moats, earnings, catalyst, obligations, and management. And we'll get into more detail on that in just a second, but it's essentially how we analyze a business pretty quickly and efficiently. It's kind of a grand checklist, so to speak. And the margin of safety component is how we would value said business, okay? So our case study today is an interesting one. It is kind of the poster child of the financial crisis, and it's none other than AIG, okay? And despite the world's contempt for AIG, right? I mean, look at these headlines right here. It's pretty bad. Despite the world's contempt for AIG, it makes for a very interesting case study given, our psychological biases towards, things that the media hates or whatnot. And we're going to go through the Mecca Method right now to analyze and see whether this may be a suitable investment for the long run. So as we go through this process right here, there will be common themes. And if you've read any of my books or articles or investment research papers or anything, you'll see these common themes over and over again, and that's also by design. We want to be repetitive to a degree. So as we go through moats, for those who aren't familiar with moats, moats are Warren Buffett's term to describe sustainable competitive advantages of a business. So he would liken a business as the castle and the sustainable competitive advantages as the moat, right? So as long as the castle is able to maintain or grow that moat over time, they'd be able to sustain earnings over the long term, essentially. So in the case of AIG, they have a dominant position in life insurance and also retirement services as a provider. They're a leader in property and casualty insurance, and they have 86 million customers and policyholders as well. And they're usually number one or number two in each of those categories, which allows them to continue to build upon their earnings cycle. So when we say earnings, we talk about real cash flow. We always have a saying, we want to count the cash, okay? Because there's accounting earnings and there's real earnings. And real earnings is cash flow, free cash flow. We don't need to get into that right now, but AIG produces a ton of cash flow. Their cash flow trends are positive, and their earnings do not appear to be manipulated in any manner. Catalysts are interesting. Not a whole lot of investors do this, but catalysts are essentially future events that help bring about the gap or help close the gap between the price you pay for security and what the company is actually worth, which is the intrinsic value. So that catalyst helps close that gap. So with regards to AIG, they have a share repurchase program going on right now after the government was officially out of the shares. They're increasing dividends, And then they also have future non-core asset sales and divestitures that are going on right now as well, which will hopefully help close that gap between intrinsic value and the current price paid. So we have obligations. Obligations, nothing kills a company faster than debt, right? Nothing kills an individual faster than debt, if you file for bankruptcy or whatnot. So in regards to AIG, they have a fortress-like balance sheet. Shareholder equity assets ratio of 15%, which is good. We don't have to go over that in detail right now, but it's very good. And the debt is very manageable and actually much better than most of the competitors in their space. So this brings us to management, the last part of the Mecca Method. So management, when you invest in a security, you're essentially investing with management, right? They're your stewards of your capital. You want them to be great capital allocators. In regards to AIG, it's an interesting situation because Robert Benboucher helped lead the turnaround of AIG after the bailout of the U.S., and he did an amazing job. It was unfortunate, but he had lung cancer and passed away just recently. But before he did that, he handpicked Peter Hancock as his successor. And he's incredibly shareholder-friendly and a great capital allocator, so we don't see any issues there. So this brings us to the last component of the 5M mental model, right, which is the margin of safety, the valuation side of the business. So it doesn't matter how great a business is, right? If you invest at too high a price, it could be a lousy investment, right? Okay? We want to make sure we're buying below the intrinsic value. If the intrinsic value is up here, we want to be buying down here, right? So in regards to AIG, it's trading at 70% of its tangible book value, which is a low-line estimate of liquidation value, which is essentially the market's telling you that the company's worth more dead than alive. And we know that's not true because they're producing earnings of $5.50 to $6.50 per share, which is 10% earnings yield. We don't need to get into that. And they also have a sum of the parts valuation of 60 to 80 per share, which is valuing each of the businesses within AIG separately. So we have a significantly undervalued stock right now. So let's do a quick recap of Mecca and margin of safety. We have a company with moats, with sustainable competitive advantages. We have a company with earnings that's producing a lot of free cash flow. We have a company with catalysts, with share repurchases, increase in dividends, sales of non-core assets. We have a company with obligation, with a fortress-like balance sheet. We have a company that also has top-line management, Peter Hancock, and great capital allocator there. And with the margin of safety component, we know that they're significantly undervalued at current prices. So congratulations, you've just analyzed a business. So that brings us to why I care about this so much, why I do what I do, why I created this entire framework to begin with. And for those of you who know who I am, you know I've had many ups and downs in my life, and as an investor, I've gone through many unfortunate mistakes early on in my career, and many of them were unnecessary. They did not need to happen at all. And it's the entire reason I've arrived at this process, and while I've spent years creating, researching, testing this framework, because it's helped take my investing and how I think about the stock market to another level, and it's helped others already as well. And all I've ever wanted was for my work to mean something and help others. So if I can continue to do that, just a sliver of that, I would consider that a life well lived. And it kind of reminds me, actually, of a story by Bob Marley, or about Bob Marley. And if you know Bob, Bob had this belief that he could cure racism and hate, literally cure it, by injecting love and music into people's lives. Well, one day, he was scheduled to perform at a peace rally. 2 days before that event, a gunman came to his house in the middle of the night and shot him down. 2 days later, he performed at that event after being gunned down. Someone asked him why, and he said, "The people who are trying to make this world worse aren't taking a day off. How can I?" And I know it sounds cheesy, but I've always believed the secret to living is ultimately giving. And there's a lot of misconceptions and bad practices that go on in the financial world and investing in general. And I mean, am I going to solve all the issues out there? Probably not, but it's not going to keep me from trying, right? And it's why our mission has always been to help the individual invest better and to keep them from making the same mistakes that I did early on in my career, because ultimately, it's trying to shine light on the darkness of a subject that's complex and dark at times, right? Because it's a subject that we ultimately all need to know and understand. So, as investors are leaving the stock market in droves, have this negative perception of the stock market, is this the death of investing? And to that, I say, no, it's only the beginning. Thank you very much.